So the question then, example 1, using the amounts detailed in the sharing story, so pause the tape and go back to it on the previous page, please. Allocate the profits of the business in accordance with the following partnership agreement. Interest on capital is 5% per annum. Howard is to receive a salary of 5,000. Interest on drawings is 10% per annum, etc. Profit sharing ratio 2:1:3:4. Mark has a guaranteed minimum profit share of 42,500. So how to lay out all this? What I'd like to do is to take you back to where we're doing all our calculations and see if we can put something meaningful together. So on page 1 of our answer, I would like to set out for Jason, Howard, Gary, and Mark, example 1, the appropriation of profit account. So let's say appropriation of profit account. So let's underline that, give it some status. So what is this? It's exactly as it says, appropriation of profit account. That is to say, once you've arrived at your net profit, in the income statement, it is then shared out between the different partners depending on what was agreed in the partnership agreement. So don't forget, the partnership agreement supersedes anything in the Partnership Act relating to the partners. The agreement is extremely important. So before they even come into the partnership, they should have worked things out as far as possible in advance. Right, so how shall we start? I suppose I better have at least 5 columns, if not more. So let's say these are all in dollars. So on the far right, I might do a little total column. So maybe a column here of decent length, 3/4 of a page maybe. And that is the total column. On the left-hand side, let's have 4 columns for Jason, Howard, Gary, and Mark. So everyone fits in quite easily. Then you have your profit itself, all in dollars. And if you remember the profit from the question, Q for question, the profit, of course, is 106,250. If you come back to, say, the first page, it says so in the very first paragraph under the description that says the sharing story. So 106,250 is where we have started. Now don't forget, our friend Mark has got a guaranteed profit share. So I might use the word guaranteed as a little bit of a warning, I suppose. $42,500 or whatever the figure was. Right, let's make a start. So simple. 106,250. You then work through your various things like interest on capital, salaries, interest on drawings, etc. So I think what I might do is let that page go. And on the next page, open up a workings section. So this is workings to Jason, Howard, Gary, Mark question. And one of the first things I suppose I should do is to work out the interest on capital. So I might make that working 1, interest on capital. Capitals, make that plural. These are all thousands, so that's fine. Interest on capitals. Now, you might have seen on the previous page, that is to say the very first page, that Jason has 100,000 capital, Howard has 20, the next two have 50 each. So let's say Jason, 5% interest on capital of 100,000. So the 100,000 capital itself comes from the very first page, though the 5% comes from the second page, towards the end of the second page where you see it says there example 1. So clearly if you multiply that out, maybe I'll just drop that dollar sign, I've said dollars anyway, $5,000. $5,000, no problem. Then we have Howard, which is obviously 5% multiplied by 20,000, so that's 1,000 of course. Then we have Gary, 5% multiplied by 50,000, and that's 2,500. And then you have Mark, multiplied by 50,000. Clearly that should be the same as Gary, 2,500. So if you look at it, I suppose what one could argue is that the total of all of that, about 11,000 I think it is, actually is a form of profit share. So profit shared in that fashion. So interest on capital, our first challenge, easily met. The second challenge, working 2, I suppose must be the interest on drawings. So for that, what I need to do is to come back to the very first page to see what the interest on drawings figures are. So let's move on to working 2. Interest, this time on drawings. Interest on drawings. And of course, if this is working 2, we have drawings by Jason, Howard, Gary, and Mark, respectively. Do be careful of this. Jason is rich but stupid, it says, withdrew 30,000. So if I put in 30,000 and multiplied by 10%, so the 10%, of course, interest on drawings is given to you on the second page, point C, interest on drawings. So from point C of the question on the second page is where I got the 10% from. Now the next issue, of course, is to try to work out the interest on drawings. What kind of, how many months should that be for? For what I can work out, Jason puts the money in and then withdraws it on the same day. So I suppose from the firm's point of view, this must be for a full year. Full year, of course, implies 3,000. Howard, moving on, could only invest 20,000, but because of a good profit share, he's withdrawn 30,000 on the last day of the year. Now, I'm going to be careful with this one. 30,000, no interest. Reason, last day of the year. That was clever, wasn't it? So that's nothing. So don't fall for that trick from the examiner. Be careful. Don't stumble over that little challenge. So I think the interest should be 0 there. Interest on capital. Feels right. The other one, Gary, the other partner, Gary, has taken out, if you remember, has a very expensive lifestyle, has withdrawn 25,000, 10% for 12 months, which is 2,500, and of course another 25,000 multiplied by, I might move our friend Mark down a little bit, another 25,000 at 10%, but this one is on the 1st of January. So if I'm counting from January the 1st to the 30th of June, I suppose this is 6 months, isn't it? So there you are. So that is a figure of 1250. So if you added that up, eventually it's 3750 that turns up there. And then you come to M, Mark, 30,000 multiplied by 10%. 30,000 multiplied by 10% is for a full year. So I suppose that is 3,000. That's quite interesting, seeing how much of the profit is. Actually, it's not so much a profit share, it's more like a penalty, isn't it? The firm gets this. So if I just quickly write that down, interest on drawings is like a penalty, i.e. firm benefits, partners lose. And the amount that we have there is interest on drawings of 3,000, 6,750, 9,750. Interesting. It's 9,750. So we have Jason with an interest on drawings. Howard, of course, took it out on the last day of the year, so he's untouched. 3750 Gary. Gary deserves it because of the amount he's taken out. And, of course, 3,000. So Gary deserves to suffer a little bit in that sense. So there you are, a few workings. My last step is to put it all together, not forgetting, of course, that the last mentioned Mark has a guaranteed minimum share. That's always a bit of a challenge in the exam. So back we go to our main answer to see if we can put something meaningful together. Appropriation of profit account. The profit from the question is 106,250. I've just put it to one side so it doesn't spoil our presentation too much. We've just worked out things like interest on capital, so I might say interest on capital. Interest on capital which of course we worked out as 5,000 for the various partners. So you've got 5,000, 1,000, 2.5, and 2.5. So I'll take away 11,000. If you agree interest on capital is a way of sharing profit, the 11,000 must be taken away from the 106 to leave about 95 to be shared out later through various means. So that's the first profit share that goes out. The next profit share that goes out, of course, is the word salaries. I think there's just the one salary to H only. We're doing some recruitment work, I think the question said. So that 5,000 goes out here. So H 5,000. So that is not there, not there, not there. Yes, 5,000 taken away here. So I'm keeping an eye on the total, I'm keeping an eye on the individual partners, etc., as we go along. What else can we say? Obviously, if you take it out of the appropriation account, which is an extension of the income statement, if you debit the appropriation account or debit the income statement, the credit, of course, goes to the current account. So we'll come back to those current accounts in a minute. But all these items, because you're taking it out of the firm, as you can see on the far right, you're taking it out of the firm, and you're putting it into, you ought to be crediting that, debit the firm, the appropriation account, and credit the individual partners' current accounts, because ultimately the firm owes that money to them. So you keep a running total, and ultimately it's settled up in cash at the end of the year, whenever it might be. Then you have this interesting point, interest on drawings. So interest on drawings, I'll just try to write that in a slightly different color because it's a different scene altogether. Interest on drawings. Interest on drawings is 3,000 coming off there, 3,750 coming off there, 3,000 coming off there, and I suppose this is 9,750. Do you think I should have brackets or not there? You're right, no brackets, on the grounds that it is the opposite to these here, you see? So it is the opposite. These two to this, completely opposite. Conceptually, the other end of the scale, meaning, of course, the 11,000 and the 5,000 is what the firm owes the partners, but the interest on drawings is what the partners owe the firm. All right, so that word opposite, quite important. Now, where are we going with all of this? If you start with 106,250 and you take away about 16,000, the running total, if you add it all up, should be in the region of 100,000. So if I pick up my calculator and just check that, 106,000, I would like you to do the same, 106,250, deduct from that basically 16,000, add to that basically 9,750, indeed that's what it is, you have 100,000. That 100,000, of course, is what you then proceed to share out as the final step in this little exercise. So how shall I do that? Perhaps it might be wise to do a running total here coming to 100,000. And so this is then shared out in the profit sharing ratio. I might drop down a line. PSR also stands for profit sharing ratio. So PSR, profit sharing ratio, is said to be 2 is to 1 is to 3 is to 4. So profit sharing ratio, PSR, save time in the exam, it's a very time pressured exam. And that goes to Jason, Howard, Gary, and Mark. So, how shall I do this? The profit sharing ratio obviously comes to 10. So I suppose what I could do is to take, for Jason, for example, 2 divided by 10 multiplied by the 100,000, which is obviously 20,000. So figures are quite easy in this question. There should be in the exam, really. So that 20,000 I'm going to add to the running total of all those figures, for example, the 3,000 in brackets. So in that sort of alignment, I'm going to bring in here 20,000 profit share. 20,000 for Jason, half of that for Howard because it's 1/10, so don't go through your calculator for that. Just use your mind, your concentration. Just look at it and decide, especially where the figures are so easy. So use 10,000 as a basis. That's one profit sharing point. 3 times that is obviously 30. 4 times that is 40. And of course, as you add across, it comes to 100,000. You see? So that you can see is the end of the main part of our exercise. See why I say you need to space it out generously over a page. There's much more yet to go. So I might extend that down the page a bit longer to see how all that works out. So I would say this comes to 0 at this stage, and that's the end of the total column. It's done its job, it's helped us, and so we throw it out. 100,000 has been shared out. Now, running through these various figures, the 100,000, by the way, is the balance, so I might just put in an asterisk. This figure here is nothing but this figure here, and which in turn, of course, is the 100,000 immediately above it, this one. So this 100,000 is simply shared, as you can see there. 1 in brackets, 1 no brackets. And so the bracketed item eats up the unbracketed. And so if you add it all up, I believe the first one is 5 minus 3, which is 2. 2 plus 20, say 22. The next one, 5 and 1, 6, and 10, 16. As you can see there, no interest on drawings for Howard. When it comes to Gary, I suppose it's the figure of 28,750 that we need. And the last one, of course, 500 taken away from 40 is about 39,500. Nothing on the far right, so I'm not adding left to right. That's why that drawing that line on the far right does help. Just put it to one side. What is the most important section now is on the left-hand side. Just out of matter of interest, what does that come to actually, those figures? Let's see if I can just add that up. The 22,000 plus 16,000 plus 28.750 plus 39.5, I'm hoping is the 106,250. So just as a quick point to check, this comes to 106,250. 106,250, which is basically broken down as you can see on the right. So all these figures do make sense now. The profit has been nicely shared out. So everyone is happy except Mark. So at a partners meeting, Mark says, excuse me, he says, do you remember before we started, I said to you, my wife and I are going to have a baby and we need some money, and you agreed that not only will you give me a higher profit share for the extra work I do and the skills I bring, the experience, etc., not only are you kindly giving me 40% of the partnership, I'm very grateful for that, but do you recall, according to our partnership agreement, you said you'd give me 42,500 as an absolute minimum. So before I joined the partnership, remember, you attracted me to move from where I was working, that old company I was working in, and you asked me to come in as a partner, and you said to me that you'll give me at least 42,500 because that was slightly more than what I was earning elsewhere. And for various reasons, we agreed that, and I'm very grateful for that. But if you notice, because the partnership didn't do quite as well as we were expecting, the 39,500 profit share that I've got is actually a bit less than what you guaranteed. So can I have that other 3,000, please? Would that be all right? And the partners will sit down and say, Mark's absolutely right. We did give him a guaranteed share. So how shall I do that? How do we do that in the exam is the big question, of course. Quite simple. Give yourself a bit of room, as often is the case with these exercises. So the profit has been shared, but not quite perfectly as yet. So as we move along, don't forget Mark is the guaranteed person, the person who has been guaranteed something. So what I think I might do is to leave a couple of lines and then rule it off about here and see what comes of it. So I suppose if I make sure that 42,500 goes to Mark, we are acting, of course, as accountants to this partnership. There is, of course, a 3,000 extra. So how I did it, I suppose, is I did this first and I did this second in the last few minutes. I did that first, did that second, apart from first sharing out the 106,250. So what we're doing is slightly realigning the partnership shares so that it's based on the agreement, including Mark's extra 3,000. So this is the guaranteed share. This is the guaranteed share. It's 1:3:4. In fact, what I will do is I'll turn it around the other way. 2:1:3 is what's relevant. So I suppose if I were to do that calculation downstairs, the 3,000 shortfall borne by Howard, Gary, and Mark in the proportion, I beg your pardon, borne by Mark as the beneficiary, Jason, that sounds better, Howard and Gary, and that is, of course, 2:1:3. That's a lot better. 3 into 5 and 1, 6. I suppose if I added that up to 6, 2/6 of 3,000, 1/6 of 3,000, that's an easy one to do, 500, and of course 3/6 is half, and 2/6 is about 1/3 of 3,000, obviously 1,000. If you add that up, there's your special 3,000. So to be born, suffered by the J, H, and G partners. So what I'm then going to have to do, I suppose, is come back to the 3,000 line and start taking out 1,500. Taking out, be careful. 500, careful. 1,000. You see, so this looks to be the third step, you see. So I work out the 42,500 first, put that into place, and then work backwards and say, oh, it's a 3,000 shortfall, and then share it out through a special working, and then deduct as I show you there. So ultimately, we come to the correct figures. The first one is 21,000. The next one, presumably 15,500. And this one, 27,250. It's interesting, in fact, to add that up and see whether, having put all those adjustments through, to see whether it still comes to the 106,000. Let's hope it does. Let's check. Put it through your calculator. 21,000 plus 15,500 plus 27,250 plus 42,500. Is that anywhere near? Of course it is. 106,250. So that is the final profit share. So let's finish off by saying that. Final profit share the final profit share is Jason, Howard, Gary and Mark. Jason, Howard, Gary and Mark. Jason, 21,000. 15,500 for Howard. 27,250 for Mark. And of course the guaranteed 42,500. For Gary, 27,250 I should say. And then Mark, 42,500. So if you add that up, that should be back to our 106,250. Now I've taken a lot of time over that on the grounds that it has a huge chance of coming up. When I'm doing revision with you, I'll come across a few of these exercises. Simpler version, obviously, is smaller bits of it, which could be those 2-mark questions that we're expecting. So that's the end of that. What I'd like to do is just come back to the notes and see if we can run with that for a while. Just bring back to life some of those points. So when you're ready, let's pick up the comments towards the end of the chapter. Indeed, the end of the course, apart from revision. Financial statements for a partnership. The format of the financial statements for a partnership will be the same as for a sole trader. So underline that, the same. Except for the capital section of the statement of financial position. So imagine what it looks like. You have your non-current assets, you have your current assets, add it up, a particular figure. In the second half of your statement of financial position, the old balance sheet as it used to be called, instead of having your share capital and share premium and reserves, retained profits, accumulated profits, that kind of thing, and indeed sometimes you have revaluation reserves. So instead of having your capital and reserves, you merge them all together to have something called a capital account, which hardly changes at all, and of course the fluctuating capital account known as the current account. That's where the action is. So you must expect the capital account to be quite quiet in the exam. It hardly changes at all, which is why it hardly ever gets examined. But the current account, of course, to be much more active. So you must be prepared to do some T accounts, as, of course, the handout demonstrates. So we move on then to the financial statements. The capital account and a current account. So each partner will have a capital account and a current account. So I might underline and. The capital account, what's the difference? Is a bit more fixed, whereas the current account is much more changing, fluctuating or changing all the time. It changes through things like the profit shares. So for example, if one of the partners is to receive a salary, you will debit the income statement appropriation section. You will debit that, and you will credit the current account. But the capital account hardly ever changes. The capital account will record the assets that have been introduced into the partnership, like cash, example. The account will remain fixed unless more assets are introduced. And the capital account, of course, will have a credit balance. So it's predominantly a credit account. At the odd time, you have some debits as well. So what happens is you have an opening balance and you have a closing balance. The opening balance will be smaller, the closing balance will be larger. And the bank account there is where more cash has been introduced into the partnership. So let's say more cash introduced by partners into the firm, the partnership, the firm's bank account. So what will happen is the bank account will be debited and the partner's accounts will be credited. So we debit bank and we credit the capital accounts. So that could be one instance. So you debit bank, credit capital account. I suppose another thing could happen is the partnership might need a building to expand its business operations. And one of the partners says, well, actually, I do have a building. If you remember, my family-owned building, you can have it. I've checked with the rest of the family, and they say, yep, you can have it. So what do I do? What does the partner do? It says to the firm, you can have the building, say, I'll introduce it, and they do a market valuation, and it comes to, say, 250,000, whatever it might be. So what happens here is because it's a building that enters a partnership, the building's account of the partnership must be debited, and the credit, of course, goes to the capital account. So one-off, quite rare things are put through the capital account. And so that is debited to the building's account, credited to the capital account on the grounds that the firm owes that money to the partnership. I beg your pardon, to the partner. So the firm, the partnership, owes that money to the partner. So it's just the same as a partner introducing a lump sum of cash. And so we come to the last page of our note, which is the current account section. The current account will record the partner's share of profits and drawings. The current account will usually have a credit balance. Let's highlight that, a credit balance, I see, but may have a debit, indicating that a partner might have withdrawn more than the profits they are entitled to. So that is just about possible, I suppose. It does also depend on the opening balance, whether they had any money in there in the first place. They could have had an opening balance of a debit balance, of course, because in years gone by they might have taken out too much money. So that's just possible, I suppose. It'd be rare in the exam, but it could happen. So the opening balance will tend to be a credit balance. Occasionally, as I say, there may be the odd debit item. So what happens here is a share of profits and the loan interest, all that kind of thing, is payable to the partners by the firm. Payable to the partners by the firm. Hence, it's a liability. Don't forget, these are all in the firm's books, partnerships books. And remember, for accounting purposes, we treat them as separate because we need a double entry situation to decide whether to debit or credit. Every transaction is a debit and a credit. So what we're saying here is we debit the appropriation section of the income statement, debit, and credit the current account. All that means is the firm, that's to say the partnership, ultimately owes these monies, things like loan interest, share of profits, etc., to the partners. Then you have drawings, which is on the other side. The drawings, of course, will be debited, and of course the drawings in the first place would have been taken out of the bank account and debited to drawings, and then the drawings account will be credited, and ultimately the current accounts will be debited. And so it comes to rest from the drawings account into the debit side of the current account. And so it goes on. So it has much more information than the capital account. Indeed, we have other things as well, which are not mentioned in the current account here, and that is where you have things like interest on capital that will appear on the credit side of the current account. Interest on drawings will appear on the debit side of the current account. So lots and lots of little items go in there on top of that. So things like the interest on capital will be credited, and interest on drawings will be debited. And so that simply makes the drawings figure worse. The capital section of the statement of financial position will look like this. You have your, apart from your non-current assets and current assets, etc., as I was saying, you have a capital account section and a current account section, which all derives from the working papers, a running total of capital accounts, current accounts with different columns, etc. So in the exam, do be careful if you are going to be laying it out, because you might have 4 partners on either side. Here we only have the 3. Let's say you have 4 partners as we had with our little firm there. You might consider turning your page around, the A4 sheet you're given, to accommodate 4 columns on either side. Use abbreviations liberally, letters for partners' names. Don't forget the dates. And of course, if you remember that capital accounts and current accounts are really credit balances in the main, the double entry, of course, goes to the P&L appropriation account. So otherwise, that brings us to the end of our coverage in terms of the syllabus. You do remember there are things like limited company accounts and partnership accounts, incomplete records. Then you have, of course, the famous threesome, the control accounts, the correction of errors, and the bank reconciliation statement. Within the correction of errors, of course, you have suspense accounts. Now, quite apart from all of that, you have to have a feel for general commercial knowledge, either by reading the Student Accountant magazine, which has some wonderful articles in there, or just reading the newspaper, daily financial pages of a good newspaper to get a feel for words like prudence and accruals and so on. And that should give you a chance to get well prepared for revision. So can I suggest at this stage, stop the tape and spend a few hours maybe running through privately, maybe overnight, all that we've covered, and see whether you can get ready for stay ready for a big revision exercise where I want to do 42 mark questions and 10 one-mark questions to simulate what the exam pressure will seem like. Just one little request. When I'm doing my revision phase with you, I'm not going to rush through it, trying to do it as fast as I can. Of course I can. But I want to do it to explain all the background. What if this had happened? What would that have happened? What if something else had happened? In other words, do very full working so you can get something out of it. So it's almost like a continuation, really, of the main tape, the main coverage. But I want to do it in another section as pure revision. Otherwise, I believe we've done everything we need to get an excellent mark on the question-based, I beg your pardon, the computer-based exams, full of little questions. Thank you.